posted a copy of the contract and some other documents that I'm going to try not to go through in any very great detail later, because they're a little boring, but I wanted some examples when I start talking about complex loan transactions, just so things that you can look at. The problem is, I thought I had them posted several days ago, so that number one, you could review what went on last week by looking through the outline and looking at your notes. And number two, a little bit about what we're going to do this week, so you can get some advanced study. It turns out, when I came in here, I found out today, thank you, that it was invisible, because there was this itsy-bitsy little unlabeled icon. Dr. Forgan and I fumbled through everything, and I said, what's that? And he clicked on it, and it said, publish. So that won't happen again. Now, now I know how to get it where it's visible to you. Because I saw everything, and it looked like it was all up there on Canvas, and then there was a box that said student view, and it was blank. So, it was an attempt, which didn't work out. Anyway, so I'm going to try and go a little bit more detail on some of the high points that I think are important. I may actually say to you things like, this is important. So that'll be a quote. Things like that. And to that end, what I'm going to try and do is stay on topic a little bit. Feel free to ask questions relating to the topic. Let's try and keep the how to get rich in real estate questions for later. Okay? Just because, and as a matter of fact, I have to, something I wanted to make sure to make a comment about, because I know that some of you have a view towards doing this and eventually getting involved in investing. And I know from past experience that people who want to invest in real estate start off, as you're supposed to start off, with a small investment. And maybe you have a friend, and you and your friend go and buy a piece of property together. Sometimes it's somebody you have a relationship, and you say, hey, listen, let's do this together. And most important thing I can tell you, because I just heard from somebody last week exactly in that situation, where their business and personal relationship didn't work out, and they own a piece of property and a business together, and they don't have any agreements. It's, when couples get married, some lawyers will recommend to them, oh, do a prenuptial agreement, especially if there's inequality of assets. And that's like, people will resist that and say, oh, you're setting yourself up to fail, and going into something like that, you're doing agreements because you think things are going to go bad. That is a great argument when it comes to a marriage, unless there's a huge disparity of assets and, private family money, you're trying to protect each other, one or another. In a business relationship, a partnership, although a partnership is the only entity in the state of Florida that you can have orally, as opposed to a corporation, a limited liability company, or anything else, you can have an oral partnership. I would strongly recommend, and this is just for those of you that may wind up in doing these small investments with your friends because you think it's a great way to start, just get it, either hire a lawyer to do something inexpensively, or get some kind of a document. It doesn't have to be super formal, but have a partnership agreement. And most importantly, in that agreement, you've got to provide for what happens if you don't agree. We use a provision called the Deadlock of Disputes Clause. It's called a shotgun clause. It's a great way to break up. You don't have to get into a fight. And I'm just going to talk about this very briefly because I said I want to stay on point. But mechanically, the way that works is if one of you decides you don't want to be in business with the other anymore, it provides for you to present a contract with a price and no names at the top, so that you present it to your business partner, and the business partner has a choice. He can accept your offer and fill in his name as the seller and your name as the buyer, or he can flip it around without changing any of the business terms, reverse it. So it keeps people honest, because you're not going to make that offer to your business partner unless you're willing to accept the same offer. So that's how that works.
So that would be in place before the partnership.
Always before. You know, when everybody's smiling and happy, or as it says, you're walking down the aisle. Before you make the investment, before the two of you sign your name on a mortgage or guarantee or anything like that, you want to have an agreement between you. And you know, a lot of times what happens is you have one guy that's got a lot of money and one guy that's got a lot of talent. And that's just not the beginning, by the way. That's all through this business, where you know you always have the broke developer that's got ideas, pie in the sky ideas, and he finds the guy with a shitload of money. Oh, sorry, with a lot of money on camera, with a lot of money, and they want to do business together. So you've got to document that kind of stuff, because you know sometimes, and we'll get into that when we get into the nature of those agreements. Hopefully, I got that down, but I want to go rewind back a little bit to some of the things that we talked about that I may have gone over a little too quickly, because in looking through my notes, and I'm going to repeat just a little bit for the people that have joined us, in looking through my notes, I was concerned that I didn't hit some of the high points and some of the detail that I want to get into. This outline, which is on the screen now, mostly for my benefit, although I have it on paper, but also so you can see what I'm looking at, I posted it, I tried to post it. It's now definitely posted, we've confirmed it, so that you can see the kinds of things that we're going over, and you can use it as a basis for organizing your notes into the things we're talking about. And I also have another cheat sheet to make sure that I know some of the high points that I'm going to want to ask you about come a couple of weeks from now. That's a clue. So, just because I think that, you know, the things that are important, I want to make sure that I'm covering the things that I think are important. For example, one of the things I wanted to go back and make sure was clear was the very first thing under the contract. Who are the parties? Because it's very important when you're looking at a contract, when you're preparing a contract, that you know who owns the property. I may find a piece of property and think I know who the owner is because he's the guy I'm talking to. And I enter, you know, I say, hey, you know, I want to buy your property. He says, great. You sign a contract and you go down the road and you think everything's wonderful, and then when you get a little further down, you start investigating the title and such, you find out that he and his brother own the property. Who thinks you have a valid contract? Anybody want to buy half the property? No? Okay, so be careful that you know that, and it's very easy to research. You know, in today's technology world, it's real easy to find out who the owners are. The other thing I want to talk about in contracts is something very, very basic in contract law, and that's offered acceptance. In case I didn't have the opportunity to go into it in any detail. Offered acceptance, let's go to that same situation, except this time let's assume that I have the right person. And I come to him with an offer, and I say, I'll buy your property for $100,000, and he writes back to me and says, no, I want $130,000. And I don't answer him. What's happened? Well, you make an offer, and there's three things that a seller can do with an offer. Accept it, reject it, or counter it. A counter offer is a rejection. Also, he doesn't have to do anything. If he ignores it and doesn't respond to it, there's no acceptance, there's no contract. That's why in the form contract, there is a provision with a time limit. It's not required, but many buyers like to do that so that if they don't hear from the seller within the time set there, it automatically terminates. Otherwise, the offer could remain open, and the seller could accept it until the buyer takes it back, revokes it, withdraws the offer. Okay. We talked a little bit about contingencies in contracts. And some of the contingencies you will see in the contract is a financing contingency. We talked about that, getting mortgages, inspections, due diligence. I said, remember, inspections, due diligence, investigation period, they all mean the same thing, but it's all the period of time for the buyer to figure out if the property meets his needs. It's usually a sole discretion standard, which is wide open for the buyer to be able to terminate the contract for any reason he wants. In some markets, if depending upon the nature of the property and the bargaining position, a seller will insist upon narrowing it down. The narrowing usually takes place when they start extending the investigation or inspection period. Because, for example, you gave him 30 days already, and by the end of the 30 days, he hasn't gotten back his environmental inspections. He hasn't gotten back his physical property condition inspections. And he needs more time just to get these third-party answers. So you can limit the inspection period. It's no longer sole discretion where the buyer can cancel for any reason, and you limit it to the one issue, whether it's the environmental, the physical inspection, whatever the one issue is, because the seller doesn't want to keep the property off the market for no reason whatsoever. But he's willing to be reasonable if everything else is okay except for the one thing that's really not within the buyer's control. Development contracts, you're going to find contingencies for permitting. So big home builders will come in and they want to build an attractive land, but they're not going to close. They're not going to give you a nickel until they know they can do exactly what they want on that piece of property. It's usually land use approvals, and it can be different degrees depending upon the nature of the deal and how patient the seller is willing to be before he's going to say it's enough time. It could be site plan approval, it could be platting, it could be building permits, which is a little unusual, and it all takes different amounts of time. Those are contingencies, and I'm going to go through some of those land use things later on. I just wanted to discuss the contingencies themselves. Title. Title is the quality of what you're getting. We'll talk about that in other detail, but that's another element of the contract. Identification of the property itself. What is the property and how do you identify it? And there's things you see all over the place, but the one sure way to identify a property is called the legal description. If you've seen deeds or anything related to property, you will see lots and blocks, or what's called the meets and bounds description. But the legal description is the only real accurate way to describe the property, even though you could look at a taxpayer, a folio number, you could look at a street address. Those are not completely accurate as to defining the property adequately for the contract. We talked about inspections and repairs. Closing. Closing is the actual time when the transaction comes to an end. This is when the buyer pays the money, the seller gives the deed. But other things have to happen for the closing to take place. One of the important things is, you see it on the board, possession. So when the closing takes place, the seller, for the most part, is going to turn possession of the property over to the buyer. Now this could be whether it's residential, it could be rental property, where there's really not getting possession, but he's getting the right to operate the property. It could be an office building, whatever it is, all of the seller's rights are ending and the buyer's rights step in. That's possession. In some situations, you'll see it if you're involved in residential transactions, you have either an early occupancy agreement or a delayed occupancy agreement. Lawyers hate these because what happens is the party who is either not yet entitled or has already given up title remains in the property pursuant to what is invariably a casual agreement. They try and do it in a few pages, but it's a situation where the party either wants to get in early or wants to stay after closing, and if it doesn't work out, if the closing doesn't occur, or if the person doesn't vacate when they're supposed to, it's a mess because it's not a lease. With a lease, you can get somebody out more easily than you can if it's not a lease, because in these documents, it's occupancy related to ownership. And instead of it being an eviction, it's an action called an ejectment, which we'll talk about more when we get into real estate litigation and things. Documents for closing. Deed, bill of sale, various affidavits, assignments. I talked about the foreign investment and real property tax. I was going to go through that again. Closing statement. Anybody ever seen a closing statement?
Yep.
Okay. So fairly easy.
Hard one?
What's that?
A hard one?
That's a form of closing statement that is typically used in residential transactions that are governed by a loan transaction. That's the technical answer. Unfortunately, in loan transactions today, the HUD-1 has vanished because now we have the closing disclosure that absolutely nobody understands, but the government says it's good for us. Even when the HUD first came out, nobody understood it because it didn't look like a normal closing statement. It looked like a monster. It's really a very easy thing to use. Many people will still, even in a non-finance transaction and not one that's covered by RESPA that requires the forms, or not covered by TRID that requires the closing disclosures, they will use the HUD for a very simple, practical reason. People are used to it, and there's a lot of software that still produces it. And the software will do the prorations for you and compute the recording costs, and there's modules in it where you can update your payoff and do per diem interest in it, and all kinds of things like that, which takes me back to these things that you see under the numbers. Closing expenses, who pays for what? I think I talked to you a little bit last week about transfer taxes, documentary stamp taxes, and how they do vary by a little bit from county to county. There's a state amount, and then there's surtaxes imposed in different counties. Those are computed based on the price. The base amount is 70 cents per $100 of consideration, except in Dade County on residential property, commercial property, where they've reduced it to 65 cents because they have a 45-cent surtax there. So that's on the dock stamps. Prorations. Residential transactions, very simple. It's usually only real estate taxes. Commercial transactions, we have an ongoing operation of property. You're going to have the real estate taxes, and you're also going to have rent, some expenses of the property, possibly insurance. It's a little hard to take over somebody else's insurance. It's more possible in complex business transactions, but for the most part, seller ends there, the buyer gets new. So any of these revenues and expenses of the property, service contracts. I just closed one a week ago before the last class for the sale of a hotel. Well, if you're operating a hotel, you have all kinds of contracts to provide services and goods to the hotel. All of those things have to be adjusted as of the day of closing because the vendors don't send their bill on the closing day. They send it on the first of the month, and trying to get a closing to take place on a day certain is like herding cats. Payoffs. You have a mortgage on the property, you're selling the property, the closing agent has to get a payoff, which is has to get a letter, a statement from the bank, directly from the bank, as to how much is due. The correct name for it is an estoppel letter from the bank. So it's a payoff letter, but it's in the form of an estoppel. An estoppel is a legal principle that says once you have made a statement and for someone else to rely upon, then you can't change your position without, if they've relied on it, they're moving forward with their transaction. And those estoppel statements are used, as you'll see, we'll get in the landlord-tenant area, by tenants to say is their lease in good standing, when is the rent paid through, what are the rights they have. But a payoff letter is really probably more commonly used for what you get from the bank that says how much is due as of today, any extra fees that go with it, late charges, escrow amounts that may be underpaid, prepayment penalties, and it's good through a certain date. And there's two numbers on there that are important in terms of dates. One is, when does this piece of paper expire? When does the bank say you can't rely on it anymore? And the other is, when is the interest paid through? So if you get it and it says the interest is paid through the 17th, but you're not closing until the 20th, there's another place where it'll tell you how much money per day to add to the statement, send them the right amount. And everybody always adds a couple of extra because money gets into transit. Per diem, I heard those words, somebody. Okay. Somebody here must have seen the closing statement. Okay, so commissions. I know there's a few brokers in the room, so I guess you guys know what commissions are, right? That's obviously, it's computed as a percentage of the purchase price. It is paid at closing. For the most part, there are some contracts where the broker would be entitled to be paid if everything happens, but the deal gets canceled for some reason the wrong way. The broker's done their job. They put a ready, willing, able buyer and seller together. They've earned their commission. It's unusual to see, but it does happen. too fast? I'm trying to rerun through some of these things with some detail. And if there are questions, let me know. Okay. Paying the price. This is something I really completely skipped over, and this is where I want to pick up and talk about different ways to do things, how you pay for the property, and that will lead me, hopefully, once I get through here, into the financing module. So, how do you pay for the property? Sounds like it should be fairly simple. You can't use a credit card for the most part. It's not like going to the store. So, simplest way, cash, wires, and checks. Sounds simple. I have had closings where people have come in literally with a bag of cash. And it was a situation, I think the person was a lawn maintenance technician, and he was getting a mortgage, and he needed to come up with about $15,000 in cash to close, to buy a house. It says right on the money, this is good for all debts, public and private. Problem is, you have reporting requirements with the federal government now. So this guy came in with 3 or 4, and I'm not joking, crumpled brown lunch bags. The cash inside was equally crumpled. They were not neatly strapped $100 bills like you see in the movies. They were, obviously, he'd done work, he got paid in cash, he put it into a box, he accumulated, he counted up. Well, it's a nightmare when you're doing this kind of transaction, because remember, I mean, real estate transactions are typically hundreds of thousands of dollars at the minimum. I mean, there may be some that are smaller, but for the most part. So, someone coming in with a bag of cash, anytime you deposit cash over $10,000, you have to fill out paperwork at the bank. Not a year goes by where I don't have 1 or 2 clients that call up and tell me that they want to do a transaction. They and the seller have talked, or they and the buyer have talked, and they want to do it with cash. And I always say the same thing. I have nothing to do with it. There's nothing wrong with it, by the way. You know, if there's anything that happened wrong, it was how the person with the bag got the money. Maybe they're in the retail business and they were skimming. Maybe they robbed a bank. Who cares? That's not the point. The point is, in terms of, if I come to you and I want to buy anything from you, from your computer to your car to your house, there is no law that says I can't give you green money. So it happens I had one, it was last year sometime, and they told me this was going on, and they asked if they could use a conference room. I knew what they were doing, I just didn't want to be a part of it. And the buyer came in with a duffel bag, you know, sports bag, yay big, and they sat in there and counted it. And the seller was happy. The seller was perfectly content. He was going to declare it and all that. He had no problem with it, but he was happy to take it, and they made the deal that way. And that's okay, fine, as long as I'm not involved in it, because I don't want to have to. And I don't. It's not that I didn't want to be involved. I didn't want to have to deposit it and report it. So
it's too heavy to carry, also, you know.
It is heavy to carry,
yeah.
but this I'm telling you, it's a sports bag. Yes.
What if it was illegitimate money?
But that's between. That's between the person who's got the bag in their hand and how they got it. Okay?
Right, so
unless you're talking about, you know, following the money. Because as between buyer and seller, let's assume the seller doesn't know anything about where the money.
Yeah, they don't know the person, but they sell the house and they get the money, but the guy's a drug dealer or whatever, and that's his money, you know?
But now he has the house.
Okay, so then
the value. So it's the person, the buyer. Now is not, you know, he's got an asset which replaced the money. So if he did something wrong with the money, the government can go after the asset.
Okay.
Can the person receiving the money be charged some sort of accessory to?
Only if he knows.
Only if he knows.
So let's say I come to you and I say, I want to buy your house. By the way, I'm a drug dealer, and I want to buy your house with my cash that I've been getting from selling coke on the streets. Do you think I'm going to come and tell you that? Or I'm going to say, look, I have a bag of cash and I want to buy your house. If you ask me and I tell you, and you know what it is, and you know it's bad money, that's different. Now there might be some criminal charge, but you know, that's not how people do business. There are ways to, and I've had people who were in that business explain to me how to clean it. It was some kind of a scheme, and I wish I'd written it down back then, not to do it, but because it was so clever. The guy was a smart guy. It's something to do where I sold you a piece of property at a very high price, and you signed a note and mortgage to me. Okay, so for my purposes, I'm selling a piece of property and I'm taking back purchase money paper. So I'm holding a note. Meanwhile, the real price, say, is $100,000 less than what you're paying me, and the note's for $100,000. And once a month, I hand you the gym bag, okay? And you use that money, and you pay me for the monthly mortgage payment, okay? And I declare it as income. It's my capital gain, whatever it is. It's showing up clean here. All of a sudden, it's cleaned. Yes, you helped. Yes, you're an accessory in that situation. But under that scheme, it's getting cleaned. Okay, cash. Checks. I'll jump, because checks are fairly easy. You're not going to close a real estate transaction with the check that comes out of your checkbook or your QuickBooks. Or why not? Well, okay, good question. You could, as long as you give the check sufficiently advance at the closing for it to be collected. And by the way, the technical word is not cleared, it's collected. So when I'm acting as an escrow agent, I'm holding a deposit under a contract, and someone gives me that check, and it's perfect, there's nothing wrong with it, then I acknowledge receipt of the escrow, but in my letter it says, subject to collection, which means I'm not responsible for the fact that I've acknowledged the deposit under the contract until that check is good. And it goes through a process. I send it to my bank sends it to your bank says, yes, you got the money, your bank pays my bank credits my account, it's collected. However, if you got the truck backed up to the house and you want to move, you don't want to wait whatever number of days it takes to go through that process. It's shortened with everything being electronic. You know, how many people here have deposited a check on their phone? Okay, so we're going to talk about that problem in a minute. So today people want to get bank checks. All right. Well, there are different kinds of bank checks. Has anybody here ever seen a certified check? No. I said I'm specific. A certified check. You from New York?
Well, actually, I used to work for the bank, and technically in the bank world, a cashier's check, a teller check, in that world, it's all considered the same thing.
No, you're missing one. I was very specific about the word certified. Have you touched a certified check compared to a cashier's check or an official check? Okay, anybody? Yeah. You're from New York.
Certified check, they do the whole thing and stamp it up.
You're from New York, right? If I remember correctly.
Yes.
Okay, so let me tell you what the difference is. A cashier's check is actually issued by the bank on its own account. It is good. It is the bank's check. You pay a fee for it, you get it, it's got gold across the top, it's got logos, it's very pretty, it's the bank's check. There is another kind of check that floats around called an official check that looks very much like a cashier's check, but it really isn't. Because if you look at it very closely, it can come from Stonegate Bank and it'll say payable through Wells Fargo, or whatever, mix up the names any way you want. So that's really a check issued by the bank, but not on their own account. A certified check, which we do not see in Florida for a reason, is issued, it's the customer's check. Look, typed up on the customer's own check or handwritten out. The bank then takes the money and out of the account, and they stamp and mutilate that check. That's what you're talking about. Yeah. They punch things in the bottom, they put stamps all over it, and they're in effect guaranteeing the customer's money it's a personal check that's been certified by the bank. The reason we do not see those in Florida is that the Florida has classified those as a promise to pay. Because what it is it's a promise by the bank that they're going to make that check good. And a promise to pay, like a promissory note, is subject to tax, documentary stamp tax. So no one's going to pay the tax on the certified check. And that theoretically, I think you can get them, but no one's going to do it because of the tax issue. That's the difference. Okay. those are the different kinds of checks you'll see. You used to see them all the time because then you get into controversies. And going back in time a little bit, you know, the Florida Bar has rules as to what we can consider to be a good check other than those checks. For example, a trust account check from another lawyer that we have a reasonable belief is going to clear. That used to be okay, and that's what everybody dealt with checks back and forth. So I would get a check from another lawyer because his client just sold something and he had the money, and then I'd issue my trust account check to pay the seller or whatever, and we knew it was okay, and that's how things worked. Today everything is by wire transfer. It's there's no more paper goes on. It's bank-to-bank transfer. The definition that we like to use for a wire transfer is an instantaneous transfer of funds that takes all day. Because we wind up sitting and waiting for the confirmations, and this lawyer's office has to have their clerk call the bank and send this piece of paper, and then the bank operator at the wire room is out to lunch. When they come back from lunch, they process the wire, it gets over here, it gets to the other bank. The other bank's got to wait for their processor to call their customer to give a confirmation. It's ridiculous. It really is supposed to be like this, and it actually is like that. It's just there's still humans involved all the way around that takes extra time. I mean, I have one client that literally goes online to his bank from his desk on his computer, logs on and goes tappity-tap, and the wire's in my firm's trust account and confirmed in 10 minutes. That's how they're supposed to work. However, with modernization comes new schemes and new tortures. Wire fraud. It's really not wire fraud as much as fraud with wire transfers. So, you are the buyer, and you want to wire me the money. Can I have the wire instructions, please? Sure. And we send a sheet with wire instructions. That should be very simple. Here's the name of our bank. Here's the bank's routing number called the ABA number. Here's our account name, our address, our account number. Please put this file reference on this so we know what client it's going to. Should be fairly easy. Well, the last bad story I heard, thank God it hasn't happened to me, but the last bad story I heard was a person said to their real estate agent, because they weren't dealing much with the lawyer, the closing lawyer, hey, can you please get me the lawyer's wire instructions? Long story short, the email got intercepted, hacked, changed. And all of a sudden, the money got sent elsewhere. Because what the person, the sender, got was a piece of paper that sure looked right. It looked like it was supposed to go to the same thing, and he didn't stop and think, why in the world is this closing agent in Tampa have a trust account in Western Pennsylvania? That doesn't make any sense. I'm not talking about a national firm. So he didn't stop to think about it. This was a significant business person who was buying a house. Anyway, part of his deposit got lost. I think he got most of it back. Now we do this, and this adds another step, but it's well worth it. I send somebody in my law firm wire instructions. Invariably, either I or someone in my office will get a call, and we read back and forth. You know, what are your wire instructions? One of us reads to the other, confirms the numbers. And you do it with a phone call to a human being. It's the only way to make sure that that wire is legitimate. The other thing that I make a practice of doing, in my closing documents, if I'm representing the seller, along with the deed and the other documents, I have a disbursement authorization that I have the clients give me their information, it gets typed in, and it's a signed, notarized document that I give to the other side so that the wire instructions are in a way. And of course, the biggest red flag for fraud is when you get the call the day or so, just a day or so in advance of the closing, hey, I need to make a change to the wire instructions. That's a bad one. Is that a hand?
Yeah.
Okay, that's a hand.
I was told that the reason why fax machines still have a place is because they cannot be hacked. Because when I do business with banks and lawyers and the medical field, and I say, well, I don't use my fax machine anymore. I gave it away. Nobody uses it. I said, why not email it to me? No, because it's susceptible to somebody hacking and taking stuff like that. But faxes, no, straight electronics.
That is a correct statement.
That's what I was told.
And you will find, dealing with anybody in the medical industry, they will only transmit back and forth in fax.
18-page.
The Internal
Title
Revenue
search.
Service, fax. Florida Division of Corporations, God help us all, fax. They are impossible.
Yes, they are.
They are impossible, and I'm trying for 2 weeks to get an acknowledgement of something being filed, and it's just, you fax and you wait. Now, the answer to your question about the hardware is there's fax software. So what we do is you scan what you want, and then it becomes a print on your list of printers. It becomes a printer. It's called WriteFax, and it faxes that way. And yes, there's something. I don't know what the differential is, why it's encrypted differently, but it's apparently more secure.
It's like eFax, right?
Effects.
It's an eFax. It's exactly what it is. But it's so you're getting a message from the 1990s. What can I tell you?
Got it safe. That's what they say.
Wire fraud, shepherd, look at that, I got through the whole thing without looking back at the outline. Okay. Anybody ever been involved in tax deferred exchange? Anybody ever hear the word, the numbers 1031? See, you all know the shorthand, but nobody knows what it really means. Okay, 1030, anybody know where the numbers come from, 1031?
Oh.
There we go. Now, okay, good. I feel a little better. So, Section 1031 of the Internal Revenue Code deals with something called like-kind exchanges. Right? What's this? Yeah. In the simplest form of a like-kind exchange, which happens once in a blue moon, I have a piece of property that you want, you have a piece of property that I want, and we sit at the table and we exchange deeds. We make some financial adjustments as necessary, but we're basically sitting across the table. I give you a deed to my property, you give me a deed, it's an exchange. That almost never happens. Years and years ago, and I don't even remember when this was codified anymore, there was a case called Starker. This is not a tax course, you don't need to remember that. That allowed for what was called a deferred exchange, where the taxpayer was allowed to sell, put the money in escrow, wait a certain amount of time, and then buy the replacement property. So that got codified into Section 1031, and people think I think it's relatively simple, but then when I was in school, I had this crazy love of tax law, and it's not that, there are rules, but I guess when you do it, it's simpler than it sounds. So what happens is, you sell a piece of property, you can't touch the money. It has to go into escrow with somebody who is not your representative. It has to go to a qualified intermediary. It can't be your lawyer, it can't be your accountant, it can't be your real estate broker, because those are all deemed related parties under the Internal Revenue Code, and it's got to be a qualified intermediary. The money goes in under an exchange agreement, which really lays out everybody's rights and responsibilities like any other contract. The taxpayer has 45 days to designate a replacement contract. Designate doesn't mean you have to be under contract. Designate simply means you have to provide a written statement to an adverse party. Could be the qualified intermediary, could be somebody else involved in the transaction saying that you designate. You can designate multiple properties. You have 180 days from your original closing of your sale running concurrently with the 45, which means the 45 is inside of the 180. You have 180 days to close. You can close on 3 properties, unlimited value, or an unlimited number of properties as long as you don't exceed 200% of the original. That almost never happens. That would be like if you sold a big shopping center and bought 12 houses. People don't usually do it in that way. You have to keep your economics the same. You don't have to take all the money from the sale and put it in. We'll talk about that in a minute. But to the extent you want to defer your tax, that's a very important word, defer. Your tax does not go away, it gets postponed. So, you have to take 100% of your proceeds, and it has to be broken down the same way. You have to do at least all the cash and replace any mortgages. Because if you put cash in your pocket for the transaction, or if you are released of a mortgage that you don't replace, it's called boot. Boot, it becomes taxable income. Usually long-term capital gain, just like the boot isn't the gain, the boot is the taxable income. So a portion of what you take out is principal, and a portion is profit, just as if you sold the thing for cash. Question?
I'm missing something.
Go ahead.
So you said the first part again? I think I didn't
First
catch
part of,
what you're explaining with the tax deferred exchanges.
okay. You want to continue your investment in real estate. You don't want to cash out because you have a huge gain. You bought your property back in the day for $100,000 and now it's worth $600,000. Congratulations. But you don't want to pay tax on $500,000 worth of gain because you like being in the real estate business. So you can take your $600,000 and you can go through this transaction and buy another piece of property within the time frames, and you will not pay, you will defer your tax.
That's the 1031?
Yes.
Okay.
On the 45 days, you have to designate one of the property addresses.
Yep.
What happens if you close on a different property in the
Doesn't
100?
count. You have to designate. If you don't designate,
So what happens if you designate a property, you go under contract for whatever reason, you can't close it, then you close on a different one?
screw
You
up.
can't
You're screwed. The only way.
Does that happen? I'm sure that happens.
Of course it happens. The way you protect yourself, because remember, you have 180 days to close. So the way to protect yourself is to designate multiple properties. Even if you're only intending on closing on one. The designation is just putting a list, which would take care of that problem. So let's say, yeah, that's it. You just, okay, I might buy this one, or this one.
Can you put as many as you want?
You can put 3, regardless of value. Actually, this is a limitation on the replacement. It's probably the same limitation on the designation, but I don't really know the hard answer. 3, regardless of value, or unlimited up to 200% of what you sold for. Okay?
You said 45 days to
45 days to designate.
designate. Does that mean you have to be under contract?
I just said that.
No. Oh, that's what I missed.
Right. We just did it again. Designate. Put it on a list. Just a list. 45 days to designate. Just pick them. You don't have to close on them. You can pick multiple ones. Okay?
Okay.
Designate. You have 180 days to close on one or more of them. And you have to keep your investment has to stay together. Now, you can add. You can certainly add to it. So again, let's take my example where your basic, one other very important point. In your replacement property, now you buy a $600,000 replacement property. I think we talked about this a little bit last week because somebody brought this up as a tax issue. Your basis in what you buy is reduced, your tax basis, by the deferred gain. So in your example, or my example, I'm just picking you as the victim. Actually, no, you're lucky because you made the profit. So the gain that you don't recognize, in this case 500,000, reduces your tax basis in the new property. Which means that in 2 years, when you sell the new property that you paid $650 for, and now you get $800, your basis is not $650, it's $150. It's the difference. It's the amount that you deferred. So eventually, that's why I say it's deferred. It doesn't go away. You're going to pay the tax one of these days. Okay?
So if you started with 100,000, 50 years later,
You keep rolling.
through 10 properties, through 10 properties now, it's up to say 4 million. Technically, it would be as soon as unless you just die with it, you just have to pay on the 3.9 million.
See, you jumped the gun because you did get the one way to escape it. Because, sorry. No, it's true.
50 years later?
Huh?
Did I hear him right or am I hearing
You got to die.
50 years later?
That's what he said. His example was 50 years. Yeah, you can die whenever you want. But
6 months.
it's a really, really rough tax play. Because what happens is when you die, your heirs, at least under the current law, your heirs get what's called a step-up in basis. So their basis, when they inherit from you, is the date of death valuation. So all that gain goes away. So yes, you got the answer to the end game, and that's what happens.
Die.
Yeah, well, I mean, when you think about it, people that accumulate and accumulate and accumulate, and they never sell, they keep rolling it. Your example, you start with 100, you wind up with 4 million. Yeah, you could sell it and pay a boatload of tax. See, that's how I said boatload. And of course you can. You still don't put the money in your pocket. You're only going to pay, let's say, 25% of the profit in tax, or at least as of right now.
So you're paying $1 million in tax.
Assuming a zero basis in his example.
Yeah, because he said $4 million gain.
No, he said $4 million value, but it's but we were back to like $100,000 basis, so it's almost the same. Yeah, $2 million in tax, but you're still putting $3 million in your pocket when you started with 100,000. You know what? Everybody's going to say that, but someone made a very good point to me. Nobody ever went broke paying income tax. Nobody ever went broke paying income tax. Because remember, you're paying $1 million, and I can promise you that must hurt. I've never had the
But
privilege.
you get $2 million.
Three.
That's three.
So, you know, however, wait a second now.
That's the whole
Let
thing
me,
about
let me carry this out for you.
Take your
Let me carry this out why this is really an important thing, this 1031. Take your example, and let's say today is the end of the 50 years, okay? And your grandfather bought this stuff when it was $100,000, and he's been rolling it all this time. And now, you've got the property, and you've got the question, do I sell it now for the $4 million, pay the $1 million in tax, or do I do another exchange and stay in it? That's the question. And here's part of the analysis. Part of the analysis is, I can only talk about today, things change over time. If you have $3 million and you want to invest it because you're going to live off the income, and you look around and see what you can earn on liquid assets in today's market, it's not as much as it used to be. I mean, what do you get, 2%? If you're a good investor, 4 or 5% maybe? However, in a good real estate investment, you can get 10 to 15%. So that's why people do the 1031s and roll their profit. The only thing, and I think we touched on this last week, the only element, and I don't know if you've gotten to this stuff in your finance, those of you that have taken the finance course, it's going to adversely affect your ability to take depreciation because you can only depreciate to the extent of your basis. So if your basis is 0 or minimal on your $4 million, because you've been rolling it all this time and deferring all this gain, the one thing that will not fit in your budget is depreciation. You're still going to have income.
Which is the 27.5
years.
Years.
Yes.
So now basically, because you don't have any more depreciation, whatever income you're getting off that property, you're claiming it as income.
No, there's still expenses, still operating expenses. But the point is, yes, it's income. But if you bought stock or bought treasury bills or whatever, you're still claiming that as income too. My point is, your rate of return on a real estate investment is going to be greater than your rate of return on cash, and that's why you're all in this classroom. Right? Nobody's in here for love. I think so. Went through that, basis, okay, parties. When you're dealing with a 1031 exchange,
Just really one quick question. The basis is how much you initially invested
Cost.
or the purchase price of the property? I guess the property's 200,000 and you put 50,000 down, the basis would be the 300,000 of the
purchase price, as a raw number, purchase price,
purchase price.
plus improvements, minus depreciation, until you start playing with the 1031s.
That's the
Alright, can you
basis.
repeat that? You said what? You said
Basic tax basis, okay?
Wait.
Purchase price, which is cost. Cost is the real word, cost. Minus depreciation, plus capital improvements. Because for example, you buy the building.
Minus the depreciation of the of
26.
that specific year?
Yes.
Of that specific
Yes. Whatever you, okay. So, your income tax consequence, when in this category, and I'm getting a little more technical than you may want, but your income tax consequence does affect your basis. If you take depreciation, whether it's, you know, the 27 and a half years you're talking about, which takes your cost, divides it by 27 years, and 1/27th is what you write off. So that's what's happening as you write it off, it's reducing what you're recognizing as income for tax purposes, right? So you're getting a tax benefit. Therefore, you get a corresponding reduction in your basis. There are other concepts not related here, where if you have to recognize certain things into income, it increases your basis. It does not, that does not apply. That's called tax cost basis. That doesn't apply. So what I'm saying to you is, yes, you're reducing your basis, but you're getting a corresponding benefit this year in exchange for it. Okay?
And when you buy another property, let's say it's a million, so you went from 300,000 to a million, 5 years later, can you still defer off of the basis, or at that point?
No, you can defer. Okay, wait, no, hold on.
Not defer, I'm sorry, depreciate, I meant to say depreciate.
Whatever basis is less. Okay, so now you have your $300,000 property that you bought, and you depreciate it to $250,000.
Yeah.
Okay, and you sell it for?
You sell it for 500,000.
Okay, so now you have a $250,000 gain. Now you're going to go and buy your $1 million piece of property using the exchange. The $250,000 gain, which you're deferring, makes your $1 million property have a basis of $750,000. Because your basis of the new property, or the replacement property, is reduced by the gain not recognized.
Now you can still
By the
depreciate
equity?
that
$750,000, yes.
By the equity that you're
Not
rolling?
equity, don't mix up it. Equity is not a tax concept. Equity is simply cost minus financing.
Well, because like you're generating a lot of equity in the property, and then that's what you're rolling.
No,
Because like let's
you
say
don't mix those up.
Taxable.
Don't mix those up. You're mixing up cash and financing with a tax concept. Keep them separate for now.
well, because what you're saying is like, and correct me if I'm wrong, is eventually you're gonna run out and not be able to do another 1031 because then you're
Never gonna no. All you're gonna run out of is basis,
exactly. So then you're gonna have
unless
to
you buy bigger.
Unless you keep getting bigger and bigger and bigger.
Right.
Yeah, but last time we spoke, you said that you're gonna run into an issue because I said because there's
It's going to eliminate your depreciation. We were just talking about that. That's the only bad thing. So you're going to pay tax on your income, and you're not going to have depreciation to reduce your taxable income in this year with.
But it's
Well,
only
you don't have the
gonna,
benefit, that's it.
it's only going to decrease the depreciation from the margin that you originally made from the property
Correct.
previously.
Yes.
But,
So it's
but
not
like
gonna
let's say you're buying
If you add
commercial
money,
though,
if you
and
add-
you're adding almost like your property value is doubling.
Doubling because you're spending more money?
Because or you're raising rents, you're increasing.
No.
money.
Don't you mix it. No, don't do that.
What do you mean? That's how you would buy commercial property for whatever 500 grand, and then you make the necessary improvements, and now it's worth $1 million.
Right. Now what?
And so you make that spread, and then you roll it into the next one. But you're saying that
No, hold on. Stay with me now. You've increased the value. That's good. That's business.
Mhm.
Now you sell it for $1 million.
You have to sell it.
Okay.
and now you
What
have
did you pay for it?
500.
And how much did you put in improvements?
Let's say we paid 400 and we put in 100,000.
Okay. So now you have a basis of,
500.
and you're selling it for
$1
$1 million.
Yes.
So how much of a gain do you have?
500.
500. Okay, so now you do this, okay? And you defer, you take your $1 million and you're deferring 500,000 of taxable gain.
Yes.
Now you go buy what? $1.5 million?
Yes.
Okay. Your $1.5 million would normally have a basis of $1.5 million.
Uh-huh.
Cost. However, because you didn't pay tax on 500 over here, the basis of the new property goes from $1.5 million down to $1 million.
What if you're leveraging like 80%?
Doesn't matter. Irrelevant.
Does that factor in the 80? I mean, the depreciation is 80%, or not 80%, but whatever. It's not including the land, right?
You can't depreciate land, but again, we're talking, right, you cannot depreciate land.
That's just factored in what you just said, though, basically.
And because depreciation is, when the improvement, the time to replace the improvements comes about, that's what the depreciation is all about.
So eventually all these big real estate guys, they're losing depreciation after like the 5th roll or whatever, the 6th or 7th, 10th. Like eventually they're just gonna have such little depreciation because it's been deferred for so long.
Right, if they keep rolling and rolling and
Like,
rolling.
because they
But
roll
if
for like
keep
20
getting bigger-
years. They roll 20, 30, 40 years. Some of them roll for their whole life.
Right, but you have to pay the tax.
Yeah.
You're still getting the revenue. All the depreciation does for you, it's another expense line item on your income statement.
So you don't have to pay the taxes on the income that you make.
Well, no, you don't. Well, it helps a little.
Yeah.
If you stop and think about it, when you really do the math, when you're talking about 1/27th, it's not like the days when and I don't even know if they allow accelerated depreciation. I don't know, we're getting a little beyond where I don't know what you guys know about this kind of stuff, but
Can
I don't think so in real estate. I'm
That's
not
cost
sure.
seg, right? Cost segregation, where you
No, that's, okay.
Acceleration, you actually
Wow,
depreciate.
all right, so cost segregation, I buy this room, let's call this room the building. So what do we have in this room?
tables, chairs.
Tables, chairs, screen, blackboard, and then we have building. So if the building has to be depreciated over 27 years, the screen may be over 3 years, the blackboard over 2 years, the table's over 5 years, that's cost segregation. Because then what you're doing is you're chopping up what you bought into its components so that you can depreciate the personal property faster.
What does that include in a property? Is that cabinets? Like what includes like as part of the building as opposed to like the things in the building? Is there a difference?
Sure. There's structure, there's fixtures, and there's equipment.
So the fixtures and equipment are the ones that you do cost seg on?
Yeah.
Okay.
And the escalation, is that when you do like over
Faster.
3 years? And then
Faster. So okay, just think about it. I'll give you the most depressing example in the room. How many of you have computers in front of you? And how quickly does a computer become obsolete because the HP PC that you had gets replaced by the Surface, or the MacBook from 3 years ago is not as good as the Pro that's out now, and then or you go to a tablet because it's easier to work with, right?
Everyone's in 3 years.
Therefore, that's going to depreciate, it's going to lose its value and its usability much more quickly than the IBM, well, maybe a bad example, but the IBM machine that runs the whole university. Because there they just have to take pieces out. So that's a perfect example of something that depreciates faster than a building. Because a building will last 27.5 years, according to some genius at the IRS. Okay, parties. I want to go back to parties. Just a little nuance here. So when you do an exchange, remember, back to the basic concept, because we got into some pretty sophisticated stuff. The basic concept is the parties have the taxpayer. You're focusing on the taxpayer. The taxpayer who sold has to be the taxpayer that buys, because the taxpayer is the one who is keeping their intact investment and picking it up and moving it to the next property. That's the idea why they're not being obligated to pay tax. They're keeping their investment. And by the way, this used to apply to personal property as well up until like a year or two ago. They changed the tax law, and it's now only limited to real estate. Because what would happen would be businesses would do it, the tractor would get old, and they would have depreciated the tractor, and maybe over 7 years. And they would take the tractor and want to go buy a new tractor. Well, when you do that and you dispose of depreciated property, there's something called recapture, where you got to take back some of your depreciation. Well, so you used to be able to roll that and do exactly the same thing with the equipment. They eliminated that for some reason. Probably the tractor lobby wasn't as strong as the real estate lobby. But obviously it's not just tractors, but it's all kinds of equipment. It's now only limited to the real estate.
So it's more the personal property which you cannot transfer to.
You can't do it. It does not work with personal property. It's only real estate, investment. Property either used in a trade or business or held for investment. You can't do it with your house. Okay, you cannot do it with something that's just.
When I say personal property, I mean personal property within the real estate business.
Right, correct. And you cannot do it with that.
Right.
So, although what happens as a practical matter, let's say you're doing it with residential, or with any kind of real estate, you don't do the cost segregation in that circumstance. Because now you're selling the building with the furniture in it, and you don't want to pay the tax, and you just say, okay, the price for everything, the whole ball of wax, is $1 million. And you don't segregate it out, and you just roll the whole thing in a 1031, and unless you get audited, and somebody realizes that that you transferred all the furnishings with it, it's going to roll. It's improper. You're supposed to, but as a practical matter, if it's used furniture and furnishings and not a lot of it, it's not going to have that much value, so it's not going to be significant.
So is it beneficial to expedite your
your depreciation or anything that you can as tax write-offs if you plan on rolling continuously.
I don't think you can, I mean, again, I haven't looked at this in a while, but I don't think you can accelerate real estate depreciation.
Okay.
Other things, yes, but not real estate depreciation.
You can't do 5 year, I've heard you could do it in like 5 years. You could like accelerate to 5 years, most people told me that, but maybe they.
There's certain things dealing with leaseholds and things like that, but that's from the tenant's standpoint.
I'm pretty sure that's like a culmination or a combination of the cost seg and then like they're averaging like everything.
Well, see, with the cost segregation, it's not the real estate you depreciate.
Yeah, but it's like within the real estate.
What's that?
It's all the improvements.
It's the stuff. It's the stuff that's not nailed down. Okay, parties. So it's got to be the same taxpayer. There's one exception to this rule, and that is if you use a single-member limited liability company, because that is a disregarded entity for tax purposes. That's where you have an LLC, limited liability company. You are the sole member, and it flows right to your tax return. And it's just, for tax purposes, the IRS says you're the same. You and the LLC are the same. And for that limited circumstance, you can use a newly formed LLC to buy the replacement property.
So
And
you
it's
can
done.
move it from,
There's no moving. So what happens is you the human sell whatever it is you're selling. And before you buy, you form the LLC that you are the only member of. And you buy it in that. Because for tax purposes, you and that LLC are the same. So you can do that. It gives protection because people like to keep their assets separate, especially in business, keep them separated.
And disregarded means that
Which means it is not treated as a separate entity for federal tax purposes.
So basically, if you had that house that you purchased 30 years ago, that was $200,000, now it's worth $4 million, and you want to roll that over when you sell it, you're basically saying take it out of your personal name, put it in you're buying the new property in a corporate name, that's allowed because it was your personal property, you would have been taxed on that person.
Be careful. You picked an example that's making me stop you. You said house. You can't do this with the house you live in. It's got to be investment property.
So let's say if it was a building shopping center.
It could be a house that you have for rental,
Okay.
but not, it
That can't be your personal residence.
right.
and not a corporate entity like you said, it has to be a single member LLC.
You can do it, if the corporate entity owns it and they want to do a 1031, that's okay, but you can't put it into a new corporation. That's not disregarded. Only a single member LLC.
Yep.
Okay?
So you cannot use the 1031
Well, 1031.
You cannot use it on personal residence.
Correct.
Because of the fact that if you was personal residence, if you lived in it for a certain amount of years, the capital gain is not taxed, right? Until a certain point.
2 years, after 2 years, you get like 250,000 of profit.
You gotta be, that's an age thing too.
Is it? I'm
I
pretty
think
sure if
so.
you own the residence for 2 years or more.
I don't think that's true. Okay. Next thing I want to discuss briefly from the real estate, the purchase and sale agreement and that is what happens when things go bad. Defaults, remedies, damages. So let's look at the buyer's side first because for the most part, when somebody's not going to come to the closing table, it's going to be the buyer. That's why the very first thing that happens when a contract is signed is the buyer has to put up a deposit. And so that deposit, once the contingencies go away, becomes, everybody refers to a hard deposit. It just means that it's non-refundable. It means that the contingencies have expired. Whether it's an inspection contingency, a financing contingency, all those things we were talking about before, once those contingencies go away, that deposit is at risk. And the way the contracts read from the buyer's perspective, they are deemed to be liquidated damages. Important words. Liquidated damages. That means that we're not going to go to court and argue about how much it cost me as the seller because you kept my property off the market for 45 days. We're going to agree that whatever the amount of the deposit is that we've agreed upon with the contract is the amount that I'm going to get if you don't perform. It's very simple. Liquidated damages, it's an agreed damage amount. So there's no lawsuits that are going to happen. Flip side, the seller decides not to come to closing. Why would the seller decide not to come to closing? You might want to take a guess. Right there, boom. That didn't take very long at all. That's the #1 answer. Now, sometimes sellers will get cold feet, especially if it's residential.
What do you say?
What he said.
Oh, I'm sorry, somebody offered him more money.
Oh.
Well, what do you mean you only got $100,000? I'll give you 120. Yeah, but I got a contract. I'll screw him.
But you have a notice of interest in the property.
What's that?
That's good.
Oh, well. Oh, where's so, what's a buyer to do? The seller doesn't have to deposit up. Well, there's a couple of different things you can do. You can sue for damages.
Or non-performance, right?
For what?
Non-performance.
What is non-performance?
Like they didn't agree to sell the property once, and it's their fault. You've done everything to perform.
Okay, so what's your remedy?
For them to sell you the house or have a notice of interest. And
Okay,
pay you.
so with the word you came close. That's why I started the question. It's called specific performance.
That's what I meant.
Non-performance is what they didn't do. They didn't perform. Specific performance is an action in equity to compel the seller to live up to the contract. Very simple. And the words are there. Specifically perform. Do what you said you were going to do. In that case, it's not a notice of interest you would file, but when you file the lawsuit, you would file a notice of lis pendens, which is a notice that gets recorded against the property that says there's a pending lawsuit, so that someone else isn't going to come along and buy it while the lawsuit's pending.
Lis pendens isn't only for foreclosure.
No.
Really?
Any real estate action founded on a written instrument. And it's abused like crazy for other actions because even though it's very often improper, it screws up the title. It puts notice, and so what happens is it puts notice in the public records. Lis pendens means pending action. And it puts notice to anybody that's examining the title that there's something going on. And even if you run to court and say, Judge, this is an improper notice of lis pendens, discharge it, and the court enters an order and says this lis pendens is no good and discharges it, it's still in the public records. They don't use an eraser. They just use a second order that says that notice that you filed is no good. That would be like you're calling a notice of interest. It's like if I got a court to say your notice of interest is invalid. But if I'm buying and I'm examining title and I see this, it's going to put me on inquiry notice to say, wait a minute, there was a lis pendens on here. That means there was a lawsuit. What happened to that lawsuit? And I'm going to go snooping, and I'm going to find if that lawsuit is still pending. I'm still not going to close.
So I've heard of investors placing notice of interest on properties that they're trying to close on. If like they think the seller's going to get cold feet or just for insurance. Do you have to specify in the notice of interest like what your compensation should be? Like if someone else was to come and purchase the property and then now you have a judgment against the property and then they would have to pay you out for you to release the lien on the property.
Well, you just made a soup of all kinds of different issues, which is great, but I don't have a strainer to go through each one of them.
Okay.
So what happens is, a notice of interest is usually and it's not something normal because it's improper. Without going and finding the contract form, I guarantee you that form that we went over last week has a paragraph that says you can't do that. So you would be in breach just by recording that notice, and it would subject you to damages, and it could be held to be slander of title because you don't have a right to do it. And you're messing my title up and you don't have a legal right, and now you're causing me a problem, so I'm going to sue you.
Is that only for commercial? Because like this is residential that I see that happening.
Same contract. The contract has the same wording in it.
That kind of borders an extortion.
And no.
It just borders because it's like when most people see a lis pendens, they automatically see foreclosure.
It's not.
And they kind of start. So he's saying that kind of file a list pendants
No, not a
and
list
give
pendants,
people the
notice of
impression as
interest.
if there's a foreclosure coming
It's-
up or
it's-
something going on, and
Like,
you know,
I know
force them to
investors.
buy you
Hold on there
up.
for a second.
I know investors that will literally they buy houses nationally, and they will literally every single property they get under contract, they'll just send a notice of interest to the clerk of courts or the city clerk.
Because they want to protect it, but
And
sometimes
yeah, they
it's
want to
not
protect
there.
their interests so that if the seller gets cold feet or someone else comes around, they're competitive in a competitive area. No one else can.
It's a form of
Right.
extortion.
It's a business practice, it's not necessarily right.
I'm telling you. And I know guys who do the same thing, and it's a form of extortion.
You're not-
Force,
you're not- you're
you
Well,
can
because
force
it's like
somebody
it's
to-
filing a notice of interest, but like because you're basically it's an insurance policy for the person not performing. So you would either sue for,
Did the seller take money up front?
huh?
Did the seller take
Even
money?
No,
when
like
you
say,
close it,
say I get in
it's
a contract
still-
with you,
it's
I
still
put up my
here.
escrow, I do everything on my part to, you know, perform. I can either sue you for specific performance, like he just said, or
Or you
like,
sue for damages.
yeah, or I to avoid that, I just file a notice of interest in the property, and then so
you're doing this
if
before, you're doing this before I get to the closing table and
Yes.
I walk away,
Yes.
so now that's extortion. If I walk
It's
away
extortion,
and I
I'm
didn't
telling
go
you.
to the closing table.
you can't walk away though because you just get entered an
Even
agreement
when
with
the
me.
deal
Line
falls
290.
apart, even when the deal falls apart, the notice of interest is still there. And that's what makes it extortion.
But you can't walk away from the deal.
I'm telling you, even when the deal falls apart
Yeah,
for any
well, so-
reason,
what I'm trying to tell you, if
No,
you get a
it's-
seller that didn't read the contract and would quickly sign, didn't read the contract, yeah, he can't walk away from it, but if a seller knows what they're doing and they make sure they put terms in the contract that you gave them, they can walk away.
it's,
And now-
it's set to
and now
bury
you're saying
people.
that-
No, if they
Who
put
don't
language
have
in there that
legal
doesn't allow me to
representation.
do that, that's one thing.
Okay,
But
but I'm saying, now you're saying that when they choose to illegally, title company and everything is said is done, they're not wanting to sell to you no more. You're saying this investor's going out and putting a lien on the property or some notice of intent. That's
You've just been
extortion.
voted off the island.
Yeah, I'm
Sorry.
telling you. I
You
know
can't do-
guys who do
it's-
the
it's-
same thing.
It's really scummy to do what you're suggesting.
yeah,
It's
I-
wrong, it's subject to damages, it's slander of title, and you're gonna get sued.
I've never done it. I
No,
just-
I'm just saying-
The whole purpose of it is that even when the deal falls apart.
It's not extortion, guys. It's not, extortion
No, I'm
is a
saying
crime.
it borders on
It's a
extortion
big
because
shot,
even
small
when,
shark type of thing.
well,
where you're
It's not even that,
even
because,
when-
wait. They can be dealt with, okay? I can file a lawsuit very quickly to clear it off the title, all right?
But the people
And then
who
I can
file-
sue him for causing me to do it. I get my attorney's fees, and if it blew my deal, I can recover damages against him because he has now slandered my
what's the
title.
clause that
The
makes
only
that?
issue is in residential, sometimes it may not be worth it, because if you're gonna buy a property and the profit margin isn't to the amount where it even makes sense, now you're stopped because there's a notice of interest from somebody else. It might not make sense to go through the lawsuit.
Well, but that's a whole different situation. Okay, lawyers have the best cop-out you will ever hear from a lawyer. That's a business decision. I can give you all the advice in the world, and you can decide to take my advice and go down the route or not, based upon the economics to you, and that's your decision. I can tell you to do the 1031. I can tell you to spend the extra $500 on the such and such inspection. I can tell you, don't file the notice of interest. But you can make a business decision to say, look, his point is, I'm going to file the notice of interest. They have to deal with me, okay? Because he's counting on exactly what you said. You may have said it's not worth by hiring a lawyer and going through litigation to chase him because I just want to make a deal. I just want to sell my property. And if that means I'm going to sell it to him because he filed a piece of paper, he wins. You get your sale. The other buyer gets screwed. And
It just becomes an issue if they don't perform though.
but
It's more than that. It's more than that. I can tell you.
now, by the way, let me just tell you.
It's more than that.
If you have a kind of transaction, and this does happen, if you have a transaction that say is extended over a period of time, let's forget the houses for a minute because that's kind of basic, and you have to go through an approval process. You have to go through some land use. You have to get the zoning changed, a site plan approved, or whatever, and that's going to take you 6 months as a buyer. You negotiate in the contract for a memorandum of contract, which is record notice, kind of like your notice of interest, except it's legit because it's agreed upon, and that protects the buyer from the seller turning around and finding somebody else to sell to during this lengthy period. Because what happens is, in that 6-month period, where I, the buyer, am out investing all kinds of money to get the site plan approved so I can build what I want to build, someone comes knocking on your door and says, why are you waiting for that? I'll give you cash tomorrow.
Is that
I can close
filed?
in 10 days. It's filed. It's recorded in the public record. So when we get to the title unit, you'll understand about notice and things like that and what the purpose of the public records is. And so that will protect the buyer, but that's agreed upon. As I found in the contract, and we pointed out because I was looking for it, in the form of contract, let's see, 290, 390? Somewhere in there, it actually says specifically this contract shall not be recorded in the public records. It's clear, and almost every single contract provides that, unless there's a specific agreement for a specific purpose. And by the way, you got to go the next step. In that circumstance, you have to have the next step where the seller has some way to clear it. Because what happens is if you have a grumpy buyer that doesn't get their approvals and just leaves, walks away, it's usually because there's money at risk, and they walk away, now you have a notice up there. How do you make the notice go away?
What did you call it? You call it a memorandum?
Memorandum of contract. There's memorandum of lease, memorandum of contract, memorandum of option. It's just a fancy way of saying notice of interest.
And if that isn't in the form or the contract, can you add that in additional clauses?
Yes.
And then say like, there's a memorandum of contract, but if buyer is to back out, then notice is to be dissolved or something like that.
Well, how?
I don't know how.
Okay, that's the next part. The next part is to protect the seller. You have to have something maybe held in escrow by the lawyer that's either a quitclaim deed or a release of the memorandum. That if the buyer terminates the contract, they either are required to sign it or the escrow agent is authorized to release it.
Okay.
Okay?
So there's no way to get rid of if somebody filed an NOI, there's no way, the only way to get it released is by the person who filed it then?
Yeah, I'll go to court.
That's ridiculous.
And if
Yeah,
you don't
that's
want
what
to
the
let it
law
go,
is.
Well, it's there. That's why you're trying to prevent it. That's, I mean, you know, but you can get sued for it, and you know.
Unless you have interest in the property, you're trying to purchase property, you're filing an NOI because you don't want that seller to sell with anyone else. I mean, I don't see the issue with that aspect of it, you know.
You still screwed up the title, and it's not your property, so you don't have the right to record something against the property. In fact, in the form contract, you're prohibited from doing it.
Don't you have equitable interest in property when you have a contract?
No, he's right. You do acquire something.
Yeah, it's on paper.
It's an equitable interest, not a legal interest. It still doesn't give you the right to screw up the title.
But now, if I'm going to sell it to money up front from you.
That's an option, maybe. Now, maybe. Who knows what it is? There's so many different variations on the business deal that, you know, here, I'll give you an example. Less normal, but it happens. You want the right to buy my property a year from now for $100,000. And I sell you that right for $10,000. If you close, you get credit for the $10,000. If you don't close, I keep the 10 for selling you the right. Now, you, the buyer, are going to want to record something to keep me from selling it to somebody else, and that's normal. That would be you would record notice of the option for sure.
But I have like,
I mean, that happens in leases too.
yeah, I know that's
Long-term
awesome.
leases with an option to purchase.
Yeah, but I've had it where an investor will get a person in a contract, and the person's like, okay, I'll let you buy my house at a foreclosure, but I need 10 grand now to move.
Different.
And then
That's cash for keys. That's a whole different issue.
So are you winning the slander of title lawsuit every single time if there's people that are doing that?
Yeah, because they have no right.
So if there's no debating that. Like that is
They do not have a right to record something against your title. And in fact, in this case, like I said, they've contracted not to.
What if like you're buying a property and you run a title and lien search and you find that? Is it the second buyer that's going to start the lawsuit, or is it the seller?
Seller. The seller's title that's been damaged.
Okay.
And by the way, there may be ways to get around it. There may be ways to prove with affidavits or other things that it's gone away.
It's difficult. We had that
Very
happen.
difficult.
We had that happen. we were gonna close on the property and someone filed an
You go to
NOI.
them things that are
They never even
unspoken.
had it under contract, they only had one of the buyers to sign it, but it didn't, it was too difficult
It
for.
messes it up.
Yeah,
Now, with things regarding leases, the title companies will let a landlord record an affidavit that says that there's, even though there's a reference to a lease, not necessarily an option to buy, but sometimes there's a memorandum of lease, sometimes there's a bank document that refers to the lease. You can record an affidavit saying that the tenancy is ended, the tenant's not in possession, and has no interest in the property, so you can make that go away.
If I have a contingency during the sale that I can't close or something until like my house is sold, right? Would I put a NOI, would I file an NOI?
No, and no one would let you.
Because
That's
it's not guaranteed that I'll sell my property.
well, it's very it's contingent. It's contingent. We don't want to screw up our title. Oh, I was just talking to somebody, has been one of my law partners. He and his wife were trying to buy a house, and they did what you should never do. They went out looking before they had a buyer, and so they come back with this ridiculous contract. And it's one thing if your house is under contract and you know it's going to close in 45 days to do it. It's another thing to try and tie up a house when your house hasn't even been put under contract. It's pie in the sky stuff, and of course the seller's going to want the right to take backup contracts and make you pull your contingency on 5 days notice. It's complicated. A couple other things I just want to talk about. Mutuality of remedies. I've already explained to you the two sides. If the buyer defaults, his deposit's at risk. If the seller defaults, he's either gets specific performance or damages. Some contracts provide only specific performance because the seller says, look, I don't want to be responsible for damages. I'll close. If I don't close, sue me, and you can make me close, which is perfectly legitimate. Big contracts are like that. The seller does not want to be responsible for damages. Buyer comes back, commercial, big commercial. Buyer comes back and goes, wait a minute. I understand that, but if you default and you don't close, I've spent $350,000 on site plans, building plans, permits, investigation. I want you to reimburse me all that money. And the seller says, that's ridiculous. I'll give you $50,000. Okay, fine, give me $75,000. They reach a number so that if the seller defaults, the seller at least has to reimburse the buyer something for his out-of-pocket expenses. However, the alternative in the form contracts to specific performance is that without the damages provision, is that the buyer has the right to terminate the contract and take his money back. In which case the contract is over and the buyer gets nothing for his troubles. If you take specific performance out, so that's the only remedy that the buyer has, now you don't have mutuality of remedies. That's important. You don't have anything that the buyer can use to enforce the contract, and that's called an illusory contract. It's floating in the air. It's nothing. If the seller walks away, the buyer's got nothing to do except whine, because the contract doesn't have any remedies. Remedies is what we've been talking about, which are the things that the aggrieved party, the one who is performing, can get from the other party. By the way, I discussed the reimbursement for expenses. The last thing is, if you have to enter into a lawsuit, remember the evil lawyers I talked about last week? Well, they want to get paid. So if you're the good guy and you've done everything right, and the bad guy does something like file the notice of interest, and now I have to sue you, okay? I want my attorney's fees paid. I want you to pay my attorney's fees because you're making me file this lawsuit.
How much would you charge for a specific performance?
I don't know. You can't quote a flat fee for that because you don't know what's going to go on in the case. You don't know if the filing of the suit is going to get the seller to come to the table and sell, or you don't know if the seller has all of a sudden, while you're playing games, the seller has already deeded it to somebody else. So now he can't perform specifically. And if the contract doesn't have an alternative damages, you got a problem. Okay? We beating this horse? It's 2:05. Let's take a break for 10-15 minutes.
I have a question, but it's off topic.
Okay. Kill the recording. No, it's off topic, just I wanted to stop it. Thank you.
The hold on.